Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker studio. We are streaming live as well on YouTube, so just head over to youtube.com and search Bloomberg Radio. Let's get a look at these markets. I mean, you come back from your little vacation in the summer, you look at the S&P, it's up 17.2%. Maybe you just go back to the beach. I mean, maybe that's not a bad year right there, right? I mean, but I think professional managers have to put money to work. I don't think they can really do that. Let's check in with Ted Oakley. He does this stuff. He's a founder and managing partner at Oxbow Advisors. Ted, if I were in your business, I might just go into all cash and take my 17% and go home. What do you guys do when I do this stuff for a living?
Well, that's interesting you say that, because we do have a lot of cash like that, because from here on out, the rest of the year, you can earn 5.5 just on the 90-day treasury. So, you've got to keep that in mind. I know we have a lot of cash, a lot of treasuries right now.
So again, if you got a lot of treasuries, what's the impetus to get that money kind of off the sidelines, if you will, to go into make a play into equities or into fixed income? Kind of what are you looking for?
Or get more bearish, right? I mean, everybody and their brother is in the soft landing camp now. It's like super consensus, even though we've had the Fed raising rates 550 basis points in 14 months.
Well, you can't count us in the soft landing group, I have to tell you. I really think people forget that recessions are caused by slowing demand. You can talk about all this other stuff, but if you look at demand in every area right now, credit card delinquencies are up, car payment delinquencies are up. You're looking at luxury good sales are down. Walmart, look at everybody that's announcing right now. Macy's, their business is down, and people are pulling back. You're looking at job openings going down. And then you still have this super inverted yield curve. And so I'm not certain people realize that when you're in a cycle, it takes a long time. This is a big battleship. And so you can't just say, hey, it's going to be a soft landing. I think a lot of people call for a soft landing probably haven't been through, a 2003 when you didn't have a real big recession, but the market was overpriced, just like it is now. I mean, we're 21 times forward earnings. You don't start a new bull market usually from that level.
Ted, some of the bulls out there would say, okay, you 21 times earnings, but you pull out some of the big cap, those 5, 6, 7 names that have really propelled the market this year. Then you're down to a more reasonable multiple. I mean, how does that kind of analysis ring for you?
Well, I understand what you're saying. I would say this, though. If you want to go the other direction and go toward the CAPE ratio, it's even worse. It's like 32 or something. CAPE, the strictly adjusted P ratio. If you adjust it for inflation. The CAPE, if you look at that, it's like 31, 32 times. I mean, what I think people forget is they want this so badly, the Fed to come back in, lower rates, and go back like we were for like 12 years or so. And it just doesn't look like we're going back to that. I can see rates coming down a lot, but I think it would be because we have weakness in the economy.
So never ever again, Paul.
What's that?
Never ever again do we get back to ZIRP.
ZIRP.
Zero interest rate policy.
Oh, no. Probably not.
Or NIRP.
But it doesn't matter because you're locked in for 30 years on your two and three quarters. So, Ted, so I take it that you're kind of still think of a recession and maybe a meaningful recession. Is that still in the cards for you?
It is. I think it's a slow go. I mean, I think people don't realize these things take time to transpire. And the worse you beat up the consumer, really, and I know they want to say the consumer's okay. The consumer's not okay. They're borrowed up the hill. Credit card interest rates are 22.25. I mean, you're in a situation right now where the consumer's in a squeeze right now. And if you you go out and talk to people in the business world, and they'll tell you that business is not as good as it was last year, just in general, or the year before. And so I think that's what people are failing to miss here. They keep trying to pull this recession in from another category. Recession starts with demand, and GDP starts with demand. So if you don't have it, and then it's not coming from the government. Our deficits this year right now are 2 times what they were last year. Same thing, and there's a reason for it. They don't have any tax receipts. Interest rates are high. They won't be able to come to the rescue either, in our opinion. They may eventually, but not right now.
Ted, you're based in Texas, right?
Austin, Texas.
Austin, Texas. WTI crude oil, $87 a barrel. You guys don't care about anything else, do you? Life is good in Texas.
Well, you would say that, but there's so many parts of the state of Texas that don't really depend on oil. Now, we own oil, obviously. We own the gas pipelines. We own a lot of things in oil, but that's just a part of a portfolio. But in certain parts, yes, it helps to have it that high. It certainly helps with cash flow for these companies when you can, instead of being 65, it's 85. That always helps. But we haven't had as much exploration as you might expect, or an increase in exploration because of the higher price yet. That doesn't mean you won't get it, but we don't have it yet.
All right. Interesting stuff in terms of oil that we're watching today, right? Because the cuts are going to stay in Russia, and the Saudis have agreed that they'll keep them until the end of the year. But it is really all about demand on that side as well. And I just don't see it rising much more than it is now, right?
It's hard to say. Oil is one of those things that it really it befuddles a lot of people, including me, by the way. So I don't know. I mean, one of the things right now, it's pretty tight supply demand, and they've taken this strategic reserve and they've emptied that out. If they were to start filling that back up, which they should, but that creates another piece of demand, and all of that was really unfortunate because that hurt the whole system. But
Ted, when you want to buy votes, you got to buy votes,
Well, that's true. The other side of it is that usually oil in the latter stages sometimes, and it's interesting. In 1977, I pulled a graph of this last week. I put it on Bloomberg, and I looked at 1977 stock market was down all year long. Oil ended up higher.
Right.
So it doesn't necessarily always go with the market. You never know exactly how it's going to go, but that's what you see from time to time.
All right, Ted, thanks so much for joining us again. Always appreciate getting your perspective. Ted Oakley, he's the founder and managing partner of Oxbow Advisors.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.